In 1720, one of the smartest people who ever lived lost a fortune. His name was Isaac Newton, the same Isaac Newton who figured out gravity, who calculated the movements of the planets, a mind so rare it comes along maybe once every few centuries. And yet he lost the equivalent of over $3 million in today's money on a single stock. Here, how it happened. Newton owned shares in a wildly popular company called the South Sea Company. The price was climbing, so he did the smart thing. He sold and he walked away with a clean 100% profit. That should have been the end of the story. But the stock kept rising. His friends were still in. They were getting richer by the week, and Newton had to watch from the sidelines while everyone around him seemed to be winning. So he did what almost no one thinks a genius would do. He jumped back in, at a much higher price, near the very top. And then the whole thing collapsed. Newton lost nearly everything he had put in. Later, he reportedly said something that should be carved into the wall of every trading floor in the world. He said he could calculate the motions of the heavenly bodies, but not the madness of people. Sit with that for a second. The problem wasn't his intelligence. His intelligence was never in question. The problem was that he let the excitement of the crowd override his own judgment. And the moment he did that, the smartest man alive started behaving like a fool. This is the single most important idea you need to understand about money, and it's the beating heart of a book written by a man named Benjamin Graham. A book so influential that a 19-year-old kid read it, changed the entire direction of his life, and went on to become the most famous investor who ever lived. That kid was Warren Buffett, and he called it, without hesitation, the best book about investing ever written. The book is called The Intelligent Investor, and here's the twist that catches almost everyone off guard. It is not a book about how to get rich. Graham says so on the very first pages. There are no secret formulas here, no hot tips, no path to a quick million. In fact, he'd probably be suspicious of any book that promised those things. Instead, this book is about something much stranger and much more useful. It's about how to stop being your own worst enemy. Because here, what Graham discovered after a lifetime of watching people make and lose money, the biggest threat to your financial future is not the economy. It's not a market crash. It's not even bad luck. It's you. Let me show you what he meant. Imagine two people standing in a supermarket. The first one is buying groceries. When the price of something goes up, they buy less. They wait for a sale. They compare. They're careful. Nobody in the history of the world has ever gotten excited that eggs suddenly cost twice as much. Now the second person walks into a store to buy perfume, and with perfume, something odd happens in the human brain. The higher the price, the more we want it. Expensive feels special. Expensive feels safe. The price tag becomes part of the appeal. Graham said most people buy stocks like they're buying perfume. When prices soar, they feel excited and pile in. When prices crash, they panic and run away. But think about how backwards that is. In every other part of life, we love a discount. We wait for the sale. And yet in the one place where a discount could actually change our lives, we do the exact opposite. We run toward things when they're expensive and flee when they're cheap. Buy your stocks the way you buy your groceries, Graham said, not the way you buy your perfume. That one sentence quietly contradicts almost everything the average person does with money. But to really understand why we behave so strangely, Graham introduces the most famous character in the history of finance. A character so memorable that Warren Buffett still talks about him decades later. His name is Mr. Market. Picture this. You own a small piece of a business, and you have a business partner named Mr. Market. Every single day, without fail, Mr. Market shows up at your door and does one thing. He shouts a price. He tells you exactly what he thinks your share of the business is worth, and he offers either to buy you out or to sell you more. There's just one problem with Mr. Market. He is emotionally unstable. Some days he wakes up wildly optimistic. Everything is wonderful. The future is glorious. And on those days he offers you absurdly high prices for your shares. But other days he wakes up terrified. He's convinced the world is ending. Everything is falling apart. And on those days he practically begs you to sell your shares to him for almost nothing. Now here's the genius of the story. Mr. Market doesn't mind if you ignore him. He'll be right back tomorrow with a brand new price and a brand new mood. He is completely at your service. And this is where most people get it exactly wrong. They treat Mr. Market as their guide. When he's euphoric and prices are high, they think he must know something I should buy. When he's panicking and prices are low, they think something must be wrong I should sell. They let a manic-depressive stranger make their most important financial decisions. But the intelligent investor does something completely different. He uses Mr. Market instead of obeying him. When Mr. Market is delirious with joy and offering silly high prices, that might be a great time to sell. When Mr. Market is drowning in fear and offering things for a fraction of their worth, that might be a great time to buy. The market is there to serve you, not to instruct you. And Graham wrote something about this that Buffett called the most important passage in the entire book. He said the true investor is almost never forced to sell, which means he's free to ignore the daily price entirely. And the investor who lets himself get stampeded by an unfair drop in prices is taking his single greatest advantage and turning it into his greatest weakness. Read that again slowly. Your greatest advantage as an ordinary investor is that nobody can force you to sell at the bottom. You can simply wait. You can do nothing. And doing nothing in those moments is one of the hardest and most profitable things in the world. Graham even said something startling. He said an investor would often be better off if his stocks had no price quoted at all, because then he'd be spared the mental anguish that comes from watching other people's mistakes flash across a screen. Think about a farmer who owns good farmland. The price of that land goes up and down over the years, but the farmer doesn't panic. He doesn't sell the whole farm because a neighbor offered a low price on a bad day. He knows what the land is worth. He watches it produce. The daily noise means nothing to him. But hand that same farmer a stock, put a flashing number in front of him, and suddenly he's checking it every 10 minutes and losing sleep over a company he'd never sell anyway. The land didn't change, the business didn't change, only the noise did. And here's a modern truth that makes this even more urgent. Scientists have found that the pain of losing money is more than twice as powerful as the pleasure of gaining the same amount. Losing $100 hurts more than twice as much as gaining $100 feels good. Which means our own brains are wired to make us sell exactly when we should be buying. That gut punch of fear during a crash isn't wisdom. It's a biological reflex. And Graham's entire philosophy is built to protect you from that reflex. So now you understand the enemy. It's the crowd. And it's the part of your own mind that wants to follow the crowd. But knowing your enemy isn't enough. You need a shield. And Graham spent his whole life describing one idea that he considered the most important concept in all of investing. If you forget everything else, he said, remember this. He called it the margin of safety. Here's the simplest way to understand it. Imagine an engineer building a bridge. Suppose the heaviest load that bridge will ever realistically carry is 10,000 pounds. Does the engineer build it to hold exactly 10,000 pounds? Of course not. That would be insane. He builds it to hold 30,000 pounds, maybe more, because he knows the future is uncertain. Maybe a truck is heavier than expected. Maybe the materials weaken over time. Maybe something happens that nobody predicted. That extra strength, that buffer between what's needed and what the bridge can actually handle, is the margin of safety. It's the room for error. It's the insurance against being wrong. Graham said you should invest the exact same way. Never pay so much for an investment that you have no cushion if things go wrong. Because here is the one risk that no investor on earth can ever escape. The risk of being wrong. You cannot predict the future. Nobody can. Graham said the only thing you can know for certain about the future is that it will always surprise you. Always. So the margin of safety is your protection against your own inevitable mistakes. And it comes down to something beautifully simple. Never overpay. Because the more you pay for something, the smaller your safety cushion becomes, and the lower your future returns will be. The price you pay determines everything. A great company, Graham warned, is not a great investment if you pay too much for the stock. Let that sink in, because it's the mistake almost everyone makes. People fall in love with wonderful companies, and they assume that because the company is wonderful, the stock must be a good buy at any price. But those are two completely different questions. Is this a good business? And is this a good price? Confuse the two and you set yourself up for disaster. Graham saw it happen over and over. He pointed to IBM, one of the greatest companies of its era, a genuine growth machine, and yet its stock lost half its value in a single 6-month stretch. He pointed to Texas Instruments, whose stock rocketed from $5 all the way up to $256. Then the earnings dropped and the price collapsed to $49. The businesses were real, but the people who paid the euphoric prices got crushed anyway. This is why Graham was so skeptical of chasing exciting growth stocks. Not because those companies were bad, but because the excitement pushed their prices so high that there was no room left for error. And when there's no room for error, a single surprise can wipe you out. There's a quiet warning hidden in all of this that most people never hear. Everyone assumes that the way to make money is to find the industry of the future. Spot the next big thing before anyone else. And Graham had seen decades of people try exactly that. He gave a perfect example, the airline industry. For years, everyone could see that air travel was going to explode. It was obvious. The whole world was going to start flying. Surely investing in airlines was a guaranteed win. Except the airlines kept losing money. In one single year, despite record numbers of passengers, the industry lost around $200 million. Even the highly paid professional experts, the mutual fund managers with all their resources, got it completely wrong about a major, obvious industry. Here, the lesson buried in that. The obvious growth of an industry does not translate into obvious profits for you. Everyone can see the growth coming, which means everyone bids up the prices, which means there's no bargain left. The exciting story and the smart investment are almost never the same thing. So what does Graham actually want you to do? At the center of everything is one clean, powerful distinction: the difference between investing and speculating. An investment, he said, is an operation that, after careful analysis, promises the safety of your money and an adequate return. Everything else is speculation. Read that definition closely, because it does something ruthless. It quietly rules out most of what people call investing. Buying a stock because it's been going up, that's not investing, that's speculating. Buying a hot new stock everybody's talking about, speculating. Betting money you can't afford to lose, that's not even speculating anymore. That's gambling. Graham didn't say speculating was evil. He understood that some people will always want to try, so he gave a piece of advice that's almost fatherly in its wisdom. If you must speculate, do it with a separate pot of money. Keep it small. And never, ever let it mix with your serious money. Never fool yourself into thinking you're investing when you're really just placing a bet. Because the danger isn't the speculation itself. The danger is the self-deception. It's the moment you convince yourself that a gamble is a sure thing. And this is where Graham reveals who this whole philosophy is really for. He splits investors into two kinds. There's the defensive investor, the person who wants safety and simplicity and freedom from constant worry. And there's the enterprising investor, the person willing to pour real time and effort into hunting for bargains. Most of us are defensive investors, whether we admit it or not. We have jobs. We have lives. We don't want to spend our evenings analyzing balance sheets. And Graham had enormous respect for that. For the defensive investor, his advice is almost shockingly simple. Split your money between solid stocks and safe bonds. Never put everything into one basket. Keep at least a quarter of your money in each, and let the standard be a simple 50-50 balance. And here's the quiet brilliance of that 50-50 rule. Its greatest value isn't mathematical, it's emotional. Because when stocks soar and everyone's euphoric, that formula forces you to sell some. Right when your instincts are screaming to buy more. And when stocks crash and everyone's terrified, that formula nudges you to buy, right when your instincts are begging you to run. The formula protects you from yourself. It gives you something to do besides panic. It replaces emotion with discipline. And discipline, in the end, is what this entire book is really about. Because Graham's deepest insight isn't about numbers at all. It's about character. He said that the intelligent investor is a realist who sells to the optimists and buys from the pessimists. Someone who has the courage to think for himself when everyone around him is losing their head. He said something that reframes this whole subject in a single line. Intelligence, in investing, is a trait more of the character than of the brain. Remember Newton. His problem was never his intelligence. It was his character in that one weak moment. It was the need to be part of the crowd, the fear of missing out, the inability to sit still while others got rich. You don't need to be a genius to invest well. In fact, being a genius can actively hurt you if you don't have the emotional discipline to go with it. What you need is patience, independence, the willingness to look foolish while everyone else chases the crowd off a cliff. And this leads to the sentence that I think captures the entire soul of the book. Graham makes a promise that sounds modest but is actually enormous. He says that if you follow his principles, especially about controlling your emotions and demanding a margin of safety, you will not get a poor result from your investments. He doesn't promise you'll beat the market. He doesn't promise you'll get rich quick. He's too honest for that. What he promises is that you'll avoid the catastrophic mistakes that ruin most people. And avoiding disaster over a lifetime turns out to be the real secret. There's a piece of math that makes this crystal clear. If you lose 95% of your money, how much do you need to gain just to get back to where you started? Not 95%. You need to gain 1,900%, nearly 20 times your money just to break even. That's why Graham cared more about avoiding ruin than chasing home runs, because one catastrophic loss can undo a lifetime of good decisions. Protect the downside, and the upside tends to take care of itself. So let's come back to where we started. To Newton, standing on the sidelines, watching his friends get rich, feeling that unbearable pull to jump back in. That moment lives inside all of us. It shows up every time the market is booming and everyone around you seems to be winning. It shows up every time the market is crashing and every instinct in your body is screaming to sell everything and run. Benjamin Graham's whole life was dedicated to helping ordinary people survive those moments, to handing them not just a strategy, but a temperament, a way of standing calm while the crowd loses its mind. And that's why, more than 70 years after it was first written, people still return to The Intelligent Investor, not because it makes investing exciting, precisely because it doesn't. It strips away the excitement and leaves you with something far more valuable: clarity. What I've shared with you here is really just the doorway. The book itself goes so much deeper, with case studies and stories and Graham's own dry, brilliant wit on nearly every page, along with modern commentary that translates his wisdom for today's world. If any of these ideas struck something in you, the full book is genuinely worth your time. It's the kind of book you don't just read once. It's the kind you return to at every stage of your financial life and find something new each time. But if you take away nothing else, take this. The market will always have its moods. It will always try to seduce you with greed and terrify you with fear. Mr. Market will knock on your door every single day for the rest of your life. You don't have to answer. Because in the end, as Graham understood better than anyone, how your investments behave matters far less than how you behave. The numbers on the screen will rise and fall. The crowd will cheer and it will panic. But the one thing you can always control, the one thing that truly determines your financial destiny, is the person sitting quietly on your side of the table. Master that person, and you've already won.